Okay, quick update. My side, firstly on the membership. We're up now to 80 members globally. So last year we actually brought in 10 new net members, mainly from the corporate side. And that's really our aim going forward. Most of the investment managers, most of the people in this room are members of the organisation on the investment side. So we really now want to grow the corporate membership, and particularly those companies in the FT Wilshire GLIO index as well. They all benefit. I think they benefit from the work that we do. I promise you. If you look at the membership, corporates in enterprise value terms, around about 1.5 trillion, which is actually bigger than some of the bigger REIT markets out there. So really well represented. And the managers from the membership of the 155 billion AUM total, our managers, the GLIO members, manage around about 100 billion of that money. Okay, so what do we actually do for the membership? I guess it's all about the platform. And the platform is wide now. We have about 9,000 active contacts that we're sending out information to. So our weekly news, our monthly members update, also our GLIO journal, which you all have a hard copy of, is going out to those memberships. We send out the weekly. The open rates of that are off the charts. It's about 60%. So it shows that people actually don't switch off at the weekend. They actually read this stuff, which is great, right? If you look at those 9,000 contacts, about 60% are either pension funds, sovereign wealth, or investment managers, buy side. Around about 25% corporates and 15% others. The platform, well, we do seminars in Sydney. This is, I think, Rob, number three that we've done. We do London, that will be after the summer this year. And we're also planning New York on September 30th with Bloomberg, hopefully. So the outreach gets bigger. On LinkedIn, we've got, between my personal and GLIO, we've got about 23,000 followers, which is great. And recently we introduced our GLIO YouTube channel, right, which has completely surprised me, to be quite honest. So we actually put up, so we do a CEO investor interview, around about 25 minutes. Our latest one is with Tim Corley from Con Ed. BlackRock, Balf Morrison is the interviewer. It's been up less than a week, 400 views, right? These are not my kids or your kids watching it. It is really into a dedicated audience. And again, mainly of buy side. So it's really, really good awareness for both the investor interviewing, but also for the corporate as well. So if you want to get involved, folks, I'm looking for Louise, maybe we should do one, right? We're always looking for content on that side. Okay, really, what's the target of the organisation? With all of the research that we do with the indices, etc., it's to grow assets under management. So if you look at assets under management since 2010, we as an industry have grown from around about 17 billion up to 155 billion at the end of last year, estimated. So look, that's great growth, year-on-year growth. It means that people are starting to understand the asset class, believe in the asset class. What's the aim of this organisation? What's the aim of us as a group? I think we can, it's optimistic, but I think we can get over 300 billion by 2030. So it's a good target to reach for. And we've seen a lot of inbound calls just in the last few weeks. So that's a great sign. Okay, the next slides really set up the conversation on the next allocations panel. This is probably one of our oldest slides, and it's where we compare the listed market with the private infrastructure market. So what you see, the red range, that's a mix of Preqin, which tends to be at the top of the range, and Cambridge Associates, which tends to be at the bottom of the red range. And between them, they'll cover just over $1 trillion worth of assets. And then we draw a simple midpoint between the two, which is the red line. The dark blue line on there is the performance of the FT Wilshire GLIO listed infrastructure index, and what you see is it outperforms private infrastructure over the long term, and it certainly outperforms equities, which is the green line. And on the right-hand side of the chart, you see the average returns and also some of the Sharpe ratios as well. Okay, again, this is also a key piece for us. It looks at earnings growth over the last 25 years. The green bars are equities earnings. So you see, you know, sort of quite volatile. There's about 7 years, I think, of downturns there. The blue bars are listed infra as covered by our index. And what you see, only 2 down years. It's pretty stable. Over long-term average, it's about 11% growth over the full period. So again, really sort of strong story. And, you know, again, if you do 15-year, 10-year, 5-year averages, they tend to be fairly similar over those different time periods, certainly when you compare them with equities. Okay, I actually had to check and sanity check this chart with Rob yesterday just to see if it actually made sense. And he said it did, so I'll now present it. So what you see is the light green line is equity growth. So we create an index from those growth figures. Equity earnings growth, and then we place the FT Wilshire equities index on top. And what you see, it sort of loosely tracks, and certainly the last 7 or 8 years, it outperforms earnings growth. The listed infra markets, that's the light blue line, that's earnings growth. And what you see is the total return index, that tracks very closely earnings growth, with the exception of the last 2 years. So maybe a question for the panel is, perhaps listed infra is undervalued at this point in time. Do we play catch up? And maybe just on a similar vein, we also do EV/EBITDA multiples. The equity market is the green line, and that tracks listed infra, which is the blue line, quite closely up until about 2019, and then equities break out from listed infra. And again, maybe a question for the panel here is, are equities currently overvalued? And does that present an opportunity for infrastructure going forward? Does it make sense? Okay, great. Okay, last slide, my side. We also do a lot of comparison with the multiples on the public and private side. The red line here is private deals. So it's a 10-year moving average of private deals. And what you see is deals are all over the place. It's very sort of volatile, all over the place. And listed infra, which is the blue line, EV/EBITDA multiple, is it ticks up over time, pretty consistent. If you look at long-term averages, we trade around about 30–40% discount to the private market. So I guess they're all questions for the next panel. Mark, I hope you were making notes as the moderator, and I'm going to hand over to you.